In this video, I'm showing you the 3 new stocks I added to my portfolio during this last week's volatility. These aren't speculative moonshots. These are boring companies that hit a price too good to ignore. If you are new here, my goal is simple. We ignore the noise, we look at the fundamentals, and we find the true value of a company. I don't buy hype, I buy cash flow. If you want to learn how to spot undervalued opportunities when everyone else is scared, make sure to subscribe to the channel. Let's get into the numbers. Just last month, the market felt invincible. November brought a reality check. We saw the fear and greed index plummet back to lows we haven't seen since April 2025. And while the broader market only dipped about 4 or 5%, individual stocks, good quality stocks, took hits of 10% or more. Before we look at the first stock, we need to understand the environment we are in. We are still technically close to all-time highs, but the sentiment shifts rapidly. We saw a lot of fear enter the market in November. When volatility hits, money usually rotates. High-flying growth stocks get punished. And suddenly, people remember that valuations actually matter. My strategy this month wasn't to chase the falling knives of risky tech stocks. Instead, I looked for stability. I went defensive. I wanted companies that print money regardless of what the economy does next. Let's look at stock number 1. First company I bought is Otis. Many of you already know what Otis is. Is a global leader in manufacturing, installing and servicing elevators, escalators. I particularly like the servicing. I really like this company. It's been on my watch list for a long time, but it always trades at a higher valuation, and I never get the opportunity to own it. Right now, it was the first time I bought Otis. I really like their competitive advantage. They have high switching costs. Once they bought an Otis elevator, they are fixed for life because they have to do maintenance, and no one in the world fails to do maintenance to the elevators. It is a kind of recurring revenue, even though part of the revenue is from new installations. A big chunk of their revenue is from recurring revenue, maintenance, modernization, which is a high quality revenue stream because it's predictable, high margin cash flow. And it's a very stable business, one of the leaders, the world leaders in this type of product. And one of the reasons I bought, when you look to the 5-year chart, it's been going nowhere, it's going down because a lot of problems on new installments, China recession, they make a lot of money in China, so they are not been doing a lot of new installments, and I believe China is getting better, so we could see an expansion, housing improvements in China and even on US, because housing is not doing very well on the US. And it is expected, with the rates going down, that we see new house construction, for example, and the housing in the US getting better. So it's all catalyst for Otis in the near future. So to conclude, Otis, it's not cheap. I get an intrinsic value around $81. Right now it's trading almost 89. I bought this company 2 weeks ago around, I don't know, $88 or 86, I do not remember, but it's still slightly above my fair value, but it's not a number, it's I would say a range, and I'm happy to start in getting a new starting position on Otis because I really like, and I hope this company or the stock price goes down so I can buy more and increase my position. By the way, all these 3 positions are starting position between 0.8 to 1.1% of my portfolio, so a lot of room to increase my position, because I do really believe this is high quality companies trading close to their fair value. But of course, if you see a great company like Otis trading at a cheap valuation, I'm willing to get a big position in my portfolio. Company number 2 is Pool Corp. I really love this company. It's been in my watch list for a long time as well, and right now I believe it's getting interested. I bought this company 2 weeks ago around $233. I really liked it because they have plenty of competitive advantage and a wide economic moat, because they are a monopoly, dominant market share in the pool maintenance and supply. Their economic moat is high switching cost and basically no competition. It's a recession-proof stock and stable outlook, which I like in this environment, because they are essential maintenance. If you have a pool, I heard a lot of people that get pools. Sometimes they don't like, or if they don't use the pool, they are always complaining about how I have to spend money for the maintenance. It's a lot of money, but they continue to do, and Pool Corp is one of the biggest beneficiaries of that. It's essential maintenance, not discretionary, so their revenues are very stable and recurring. So their business is going nowhere. They face no competition. Even if you want to compete with pool, you have to spend a lot of money, and it will not be profitable. So it is a business that is stable, predictable. Demand for the next few years, I believe in next 5, 10, even 20 years, there will be a market leader as well in pool. And people getting rich will like to have pools, so it's something that the demand will increase in the future. In terms of market context, Pool Corp had a market boom during COVID. People at home want pools. There was an increase in pool construction, so there were a lot of demand for their products. So the stock skyrocketed. So that's why this stock has been in my watch list, and I never bought this company. So right now, I believe it is a really great company that is going down so too close to their fair value. So I really believe right now it's the time you should look into this company, because this is a great company, and it's getting close to the fair value. My fair value for this company is around $244, $250. So right now it's at 243. I'm really happy that I got the opportunity to buy this company at $233 2 weeks ago. So I hope this stock continues to go down, so I can increase my position, because it is a really great company that I really believe it will be a compounder in the next few years. Company number 3, we are switching from industrials to consumer defensive. It's Unilever, the owner of brands like Dove, Ben & Jerry's, Hellmann's, Persil. It is very good brands and household products which are very defensive by nature. In terms of growth ahead, they've been not growing very good in the past. Revenues are going up, but profits are not increasing. But it is expected in the next few years they recover profitability, so they will continue to grow and increase their margin. So it is a very good, it's a catalyst I'm expecting for the future. And I really believe in the next 5, 10, 15 years they will not go in nowhere, because people need to trust these brands. There are plenty of staying power, and household will continue to buy into Unilever brands products. So I see no risk of technological disruption, which is something I really like in this environment. This is an exuberant market. People are investing. It's basically people are investing in the future with high risks, expecting high rewards. And I do not believe when this happens, when everyone is expecting high returns, risking a lot, it turns like maybe a bubble, maybe it is not, but it is an exuberant market. And when I look into the risk reward, I like Unilever proposal. So it's trading at the lowest forward P in history. It's a very good company, well managed, and I do believe it's, in terms of risk reward, one of the best opportunities right there. And even if you get a recession, a crisis, a bubble popping, so I do believe Unilever will perform very well. And in this type of market, I prefer to buy high quality companies with historic value that are very defensive and propose a very good return. At this valuation, I'm expecting around 10 to 11% returns. So and I came with an intrinsic fair value for me around $57 to get that 10% return. And right now the stock is trading at $60 to $61. I got the opportunity to buy this company at $59 2 weeks ago. It is close to a fair value, and if the stock goes lower, I'm very happy to increase my position as well. So it's part of my strategy, since if the stock a good quality company trades at fair value, I start a position, and if the risk reward situation, if the valuation goes down, the risk reward gets better. So the lower the stock price, the lower the risk is to buy this company. At least it's my strategy, and it's something I always do in my buys. So those are the 3 companies I bought in November. You'll notice a theme here. They are boring, stable, and defensive. I am not buying these because I think the market is going to crash tomorrow. I don't have a crystal ball. I am buying them because at this specific moment, this is where I believe the best risk-reward opportunities are sitting. While everyone else is chasing the same expensive AI stocks, I'm happy to picking up some high-quality cash flows that have been thrown out with the bathwater. Now, I want to hear from you. Did you buy the dip in November, or are you sitting on cash waiting for a bigger drop? Let me know in the comments below. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.